Hello, everyone, and welcome to Wholesale Change, the webcast and podcast from Distribution Strategy Group, where we offer thought leadership for wholesale change agents like you. Because if you're on this show, this call, you probably are a wholesale change agent. My name's Ian Heller with Distribution Strategy Group. I'll be your co-host today, along with my wonderful business partner, the Doctor of Distribution, Jonathan Bein, PhD. Jonathan, how are you today, my friend?
I'm great. An apple a day keeps the doctor away.
Well, I haven't had an apple, and thus you're here, doctor.
Exactly.
So good. Well, we have a fascinating show today. Go ahead.
But you have an apple. You just haven't had an apple.
Yeah, you computer scientists are so precise. I don't even know what to say.
Yes.
Anyway, so our show today wound up taking a bit of a different direction. We were going to talk about really the rest of the year in M&A and distribution for 2022, but we want to get wrapped up in 3 deals, right? And so we're going to spend most of the time talking about those deals, and then we'll talk a little bit about what's happening in 2022, and then tell you about a show we've got on February 16th, where we'll bring in distribution M&A expert Brent Grover to have a more in-depth discussion. The topic was just too big for one call, so we'll mostly focus on a few specific deals that we'll tell you about in a moment. But before we do that, we want to thank our sponsors and talk about them, because without them, this show would not be possible. So the show is brought to you by 2 sponsors. First, let's talk about Epicor. Are you finally ready to integrate all your business functions with an enterprise resource planning system? Or maybe you're struggling with legacy computer systems that just aren't cutting it anymore. Your IT costs seem never ending. Your servers are at the end of their lifespan. Your systems don't talk to each other, and you can't get decent reporting to make informed business decisions. Does that sound like you? At Epicor, they get you and your unique distribution challenges. Epicor has been around for 50 years. Their ERP solutions were designed with distributors for distributors like you. Epicor for Distribution goes beyond standard ERPs to provide innovative, highly focused solutions that are made for and essential to your business. Learn more about how Epicor has helped thousands of wholesalers succeed by visiting epicor.com/distribution. So thank you, Epicor, longtime sponsor of the show. And would also like to thank Cavallo. This is the second episode of Wholesale Change that Cavallo has sponsored. If you're not familiar with them, Cavallo is a distribution management solutions provider founded by an experienced distributor who spent decades perfecting and optimizing a high-powered, user-friendly solution built for distributors. Cavallo offers a robust set of execution-based software that provides sales teams with critical customer information to speed up order processing with precise control over every order, including workflow automation to ensure efficiency and accuracy across all your processes. You can also leverage Cavallo's state-of-the-art business intelligence platform to know in real time if an order is out of compliance or in jeopardy, and where you can improve to power your company's next big moves. Cavallo's data-driven approach has created the best case scenario for modern distributors, software that meets you where you're at with flexible on-premise and cloud options that empower users to take their next technological step at their own pace, no matter where you are in your technical journey. It's time to take control over your distribution business with software built for distributors without adding a new ERP. For more information on how to experience accelerated growth with Cavallo's business intelligence platform and its distribution management software, visit cavallo.com today. Okay, so thanks very much to our sponsors. And now let's jump into the content for today's episode. So as we said, we will be talking some about wholesale distribution M&A for 2022. But we really got wrapped up in these deals as we started getting into them. The first one in particular is very, very complex. Lawson Products is acquiring Gexpro Services, which is a supply chain solutions provider, and Test Equity, which sells test equipment and some MRO products. Lawson itself is an MRO distributor. And so I was really the primary person researching that deal. We'll talk about that for a little while, then talk about Motion. And Jonathan, you did the Motion Kaman deal research. And then we'll briefly talk about Whitecap and Ram Tool. That's a very straightforward deal. Motion and Kaman's pretty straightforward as well. But Whitecap and Ram Tool is sort of, Whitecap doing what it's been doing, which is buying competitors. It's pretty straightforward. So these are the 3 deals we'll primarily talk about. We'd love to get your input as we go. Please feel free to use the chat or the Q&A, and you can address those specifically to us if you don't want everybody to see your question or your name. But we'd love to get your input as we go. We'll be asking you some questions along the way. So,
Just a brief
Jonathan,
comment, Ian.
yeah,
None of these deals is acquiring another branch or two branches. These are all really significant deals. And it's a little bit unusual to have this many significant deals in such a short period of time, right?
yeah, I think that's right. I think, these sort of happened at the end of 2021 for the most part, but they're huge, right? And I think it is a sign that there's going to be a lot of M&A activity in 2022. But let's jump into the Lawson deal first, because it's really a complex deal. So Lawson and they wound up releasing the financials for the two privately held companies, Test Equity and Gexpro Services, as part of the deal, right? And so if you look at, let's see there, there's a 638 page deal book that you can download. And I went through the whole thing. I obviously didn't read every page, but I went through the whole thing. And basically through 9 months, through September 30th, so, through 3/4 of the year, Test Equity had done about $209 million in revenues. It had lost about $4 million. And they've been losing money for the last 2 or 3 years based on information in the deal book. Not a lot. Gexpro Services is a little bigger. They did $247 million through 9 months and made about $11.6 million in profit. Lawson did about $316 million in revenues for the first 9 months and made about $10 million. And so the combined company through 9 months did $772 million in sales. So they're saying it's going to be $1 billion company in revenues when it's over. Okay, when the deal closes. And year to date made about $9 million after 9 months, but they're anticipating $100 million in EBITDA when and $1 billion in sales. That's their target. What they say. I mean, this deal's really being led by Luther King Capital, who either owned or most or all of these companies prior to the deal, and apparently, anyway, led the combination of the three. Now, the reason this is I guess, odd, unusual deal is these companies, at least to me, and Jonathan, I'd love to get your view on this. They don't appear to me to have a lot of customer synergies. Do you think so?
That's how it looks at first blush. And if you sort of peel back the Test Equity history, they have done a number of acquisitions on the MRO side of the business. They have a testing side of the business and an MRO side of the business. And the investment thesis there was there were synergies between those two parts of the business. But now you have things that are seemingly more disparate. Looking at the MRO part of Test Equity, that does seem to align very well with Lawson. That is complementary to Lawson.
Well, Lawson's mostly a fasteners distributor, right? And they have a sales model, right? They have what I would say are relatively highly paid sales reps who literally take a lot of the orders, right? And Test Equity is primarily a e-commerce based business, right?
In part, I mean, the part of the testing side of the business. So think Tektronix, products like that. Part of the testing side of the business that they have there, they do a lot with rentals, and that business in general, whether it's Test Equity or Newark Electronics or any of the other competitors, those are very large transactions. I think many of us are familiar with typical MRO transaction, $300 to $800. The transactions in that testing space are a multiple of that, not a percentage higher. So those are very different business models in which to obtain the synergy.
Yeah. So they in their press release they spoke to some synergies, and they said that combined pro forma annual revenue will be $1 billion and EBITDA of more than 100 million, as I mentioned. The combined entity will have a balanced mix of production, OEM, and MRO, serving a combined 120,000 longstanding customers. And I think the way this breaks down, I think Lawson's got 90,000, Test Equity has 30,000, and Gexpro's got like 1,800. Because Gexpro, they do supply chain work to support Kanban production lines and that kind of thing. So they have fewer very large customers. Ability to enhance long-term organic growth rates through offering more products and services to each company's customers. So this is the sales and marketing synergy. So they're really claiming three kinds of synergies here, right? Or three advantages anyway. One is that they can cross-sell, right? That's the typical thing. And that's hard to do, right, Jonathan?
It's hard because it means if you've got a person who knows about fasteners, he or she now needs to know about selling testing products or a certain class of production supply products. So the knowledge transfer, and this is going to be a theme throughout the deals that we have, by the way, the knowledge transfer required to get that cross-selling synergy is harder than closing branches to, duplicate branches, right?
Yeah, right. Eliminating redundancies is more straightforward and lower risk than cross-selling. And the other, you remember when we had Darren Rawson, the CEO, the president, I guess, of AZ Parts Master on the show, and he was talking about how when Home Depot bought HD Supply maintenance solutions, some customers actually decided to do that was now too big a supplier for them. They wanted supplier diversity. So they actually went out and signed AZ Parts Master as a new supplier to offset the fact that HD Supply and Home Depot now were a very, very large proportion of their purchasing, right? And so I don't know if there's that effect here, but it could be. And to your point, it's kind of hard to get some of those sales synergies. I mean, I think, look, these are very, very sophisticated investors. They would have properly discounted or accounted for the fact that these things are hard to get. I'm not implying that they're overestimating, but they still have to go through the hard work of getting it, right?
That's right. Yeah, I think just a word for our audience, Luther King Capital Management is about the pinnacle in private equity for distribution in terms of sophistication, right?
Yeah, it's super high integrity. I mean, these are great. I mean, that's the reputation. I haven't worked with them much, but that's the reputation. Okay, the second area where they're looking for synergies, and this is a really interesting one, and I think maybe the one where I have a bit of a hypothesis that I like the audience to respond to. It may be crazy, but there's a robust acquisition pipeline with active negotiations with several accretive targets likely to close in the next 6 to 18 months. Okay. All right. So they're currently negotiating to acquire a bunch of companies, right? I mean, which probably means all three of the entities they're combining have some acquisition targets, right? And their negotiations are underway, correct? Okay. So here's my view on this. This is my crazy view on this. I think part of the motivation here is that although Luther King Capital was, the majority owner, I believe, or the largest owner of various shareholders for all three of these entities, and they can't just combine the balance sheets of the three unless they create a holding company out of them. And so if you take these three companies and you create a holding company, which is what they're doing, I mean, they're saying they're going to continue to operate them independently. The current CEOs are going to stay in place, right? So it really is a holding company kind of structure, which is really smart, I think, because you can't really just combine the operations of these companies. They're too different, right? But by combining them into a holding company, you create a combined balance sheet. And that gives, for example, Test Equity and Gexpro Services access to Lawson Products balance sheet that they wouldn't have otherwise. And I think Lawson, in many ways, is a hard company to use as an acquiring company, right? Because they live on very high margins. I think they're about 50% gross margins. They have highly paid sales reps. So if you're going to acquire somebody, unless you're going to use a different sales model for whoever you acquire or not disturb the one that they already have, you're going to have to find products that are that kind of margin and that need that sort of very, very high touch, intense personal selling approach that Lawson uses, which works great for Lawson. I mean, it's a very, very well-run company. We had Mike Decatur, their CEO, on the show a few months ago. And in his tenure at that time, the stock had gone up tenfold, right? And we compared that to Grainger that had gone up, I don't know, like 100% or 200%, and MSC that had gone up less than that. We're like, oh my gosh, this is one of the best untold stories in distribution, is how fast Lawson has gained enterprise value.
I think anybody who's got a tenure should have a tenfold increase.
What's that?
If it's a tenure, it should be a tenfold increase, which is what you said. So he's right on schedule.
Yeah, I don't know if he's been there 10 years. I don't remember, but the growth of Lawson stock over that period of time, the only one I could find that was similar for a big company was Amazon, which was up 12-fold. So you're talking about extraordinary performance. But I think it's hard to acquire companies. And so if you combine them, because like Test Equity is a much more straightforward platform to acquire companies with. Do you agree with that premise?
Oh yeah, absolutely. I mean, Test Equity has done a number of acquisitions. On the MRO side, they bought a division of Grainger, and then they bought, which was kind of the brand they're going with on the production supply side, and then they added 3 or 4 other companies in around that. Okay. So,
yeah. Okay. So anyway, so I've got this maybe cockamamie theory that they're just combining the balance sheet so that they can expedite acquisitions that are easier to find for Test Equity and maybe Gexpro services than they are for Lawson Products. So that's my, so we've already talked about some sales and marketing synergies, and they do talk about how Lawson will benefit from the e-commerce capabilities that Test Equity has. And then the third area where they talk about synergies is on the purchasing side, right? So they can enhance product sourcing opportunities with including private label opportunities while expanding channels to market. So this is, sort of sourcing to selling, adding new channels and new private label opportunities, and probably some sourcing leverage and synergies potentially. Although I don't think these companies have a lot of crossover in their product mix. And then the fourth area, I think I said there were 3, but I think there are 4, is the ability to leverage best practices, back office resources, and technology across the platform to drive operating efficiencies. Now, that's sort of your classic redundancy elimination type of synergy. So those are the 4 areas where they see synergies. My personal view, I'd love for the audience to weigh in, is that this combination of balance sheets into a holding company is the most compelling of these and would appear to me to have the most value. And
yeah, and that now they are a different scale as a company, right? So as a $1 billion player in the industrial space, you go from 50th or whatever Lawson was, and I don't know the number, so I don't want to be accountable to that. You're in a different scale now, right? You're the next player you're trying to compete against is in the $1 billion category, and that's a very different thing than what they had before.
Okay, so let me ask you this: do you think Lawson is now a more formidable competitor to companies like Grainger, MSC, Fastenal, et cetera, as a result of once this transaction closes?
Absolutely. Because an expansion of services and capability. So if we go back to our complexity model, right, their acquisition of Gexpro allows them to handle more complex transactions that involve more value-added components, which is very different than the Grainger model, right?
Okay, so you think they're going to take that Gexpro services capabilities, which are very robust. I mean,
right.
It's a much bigger company than I thought. I mean, because these were privately held, I didn't see their financials before. If they had disclosed them, I hadn't seen them. Mm-hmm. But now they did as a part of this. So you think they're going to take those capabilities in Gexpro services and sell Lawson products through them and expand the marketing reach of Gexpro services?
Yes, correct. And if you look at Lawson, I mean, they're very strong in things like VMI, bin replenishment, all that stuff. It is their hybrid CSR sales rep model right? You have sales reps doing it all, right? The person that comes to the premise is doing it all for them, right? They don't have a distinction between sales reps and customer service reps. So it's a highly value added model. And I think that the supply chain stuff is very complementary to that.
Yeah, we have a question from the audience. With cost of capital so low these days, why would an improved balance sheet and borrowing be such an important synergy? So I think that is the core question to challenge my hypothesis. So thank you for that. So I thought about that, and I don't know that I have a definitive answer, but I'll tell you my point of view on it. So if you have a combined balance sheet for an entity that you are the owner of and that you control, then it's much simpler to make acquisitions than the typical PE method of raising a fund and enrolling investors. And, I mean, they do it all the time, so it's not hard, but it's very straightforward. If you own the company, you don't need to, get anybody's permission, I guess, to go make acquisitions, and you can fund them with cash on the balance sheet rather than, generating new forms of equity or incurring debt. So I
even
guess
less expensive cash on the balance sheet than the cost of capital that Jeff's referencing, right?
Yeah, it could be. I mean, I think it depends on what happens with interest rates. With interest rates going up now, perhaps that is the case. But anyway, so I don't know. I mean, I think you're asking a great question. I'd be interested in how this person responds to my answer to them. But that's all I can think of. And I'm struggling a little bit to understand the synergies in this deal. And so, it's kind of like, what Sherlock Holmes said, if you eliminate every other possibility, the remaining one must be true. I don't really buy that the customers facing synergies are that have enough benefit to drive this deal. The purchasing synergies and the back office synergies, I feel the same way about, but these are brilliant people. They make smart acquisitions. They do a good job. There's got to be a reason. And so I sort of settled on this, combined balance sheet hypothesis, but it could be wrong. Anyway, so that's my view on those three companies. I think the Mike Takeda and Ron Knudsen, who are the CEO and CFO at Lawson, are going to be the heads of the holding company that all three entities roll up into. And I think based on their performance over the last several years, this holding company is going to be in good hands. Anything else we want to talk about with that deal, or should we move on, Jonathan?
I think let's transition.
Okay, good. All right, so let's talk about Kaman and Motion.
Terrific. So the deal with Kaman and Motion. So Motion is a $6.7 billion forward. It was a forward revenue for 2022. Kaman is $1.1 billion for 2022. EBITDA for Motion is about a 10%. EBITDA for Kaman is about an 8%. When you put the two of them together, the projections show just under $8 billion, $7.8 billion revenue, $815 million EBITDA, and about a 10.5% EBITDA post-merger. So they're showing a story that is going to be accretive in calendar year 2022, and it will make them the second largest industrial distributor in North America, trailing only Grainger. So this is a significant move for Motion. If we look at the kind of Motion's history on acquisitions, they've done 3, 5, maybe 6 a year over the last decade on average. And most of those acquisitions are small. I mean, they are 15, 20, 30, $50 million. They acquired a company called Miller Industrial. I think that was 150 million. So they tended to acquire smaller properties as part of their acquisition strategy. They've spun off companies. They spun off EIS, which was not quite a fit. It was more on the electrical side.
Mm-hmm.
GPC spun off SP Richards, which was more on the
office products.
Yeah, the packaging and the Jansan world. So this is a really, really significant move. So you have the largest player getting even larger, and if you look at the sort of remaining large players in the sector, AIT I think ends up being next in the space, and Motion was already larger than AIT. That's Applied Industrial Technology. The deal itself is valued at $1.3 billion in cash. So Kaman, was in a good position to get a good multiple on the valuation. Here's some ways to think about this particular deal. In terms of the synergies that they're looking at, they're looking at the branch redundancy. So there will be branch reduction. They're looking at supplier overlap, where they can get significantly more buying power from those suppliers. And then they've also looked at the customer overlap. And Ian, a point that you brought up earlier today is that sometimes what happens is like what you mentioned with HD Supply and
Ram Tool.
No, I'm sorry, HD Supply.
Oh, and Home Depot.
And Home Depot. Yes, thank you.
Right.
Yeah, all these H's and D's get me confused. So one of the things that was noted in the analyst calls was that no single customer of either company represents more than 10% of the deal, and they really felt like that risk of having too much within one customer concentration, or the risk you brought up of customer says, great, you're too big with us, we're going to get a secondary supplier. The CEO of Motion said, there's a lot of smaller companies where they have big opportunity to cross-sell and to cross-fertilize. So the main sort of synergies from a product standpoint, if you look at Motion, something like 35% of their revenue is bearings and power transmission. Next is hydraulics and pneumatics. I'm not talking about the MRO side of things. I'm really talking about the PTMC side of the house. Next is seals, pumps, and hoses. And then a distant fourth in those categories is electrical and automation. So a lot of what Kaman is bringing is the fluid power and the automation. Those are going to complement Motion's products very well. And then also Kaman has got significant engineered solutions capability. And that's been true for a long time. So you're already in a sector that is differentiated by value add, right?
Right.
There are some simple transactions, there are plenty of them, but there's also a lot of more complex transactions. And so the Kaman capability in the engineered solutions takes Motion overall more towards more complex transactions. Did you want to handle the question there, Ian?
Yeah, so we have someone asking, was the HSR review, that's the FTC's antitrust review of deals, a significant hurdle for this deal, for this Motion Kaman deal? I don't really know. It
didn't come up in the analyst calls.
Yeah, I know, and it's funny because I think this is, I don't have data to support this opinion. I think the FTC, because of all the disruption happening with major players like Home Depot growing at ferocious rates in industrial supplies and construction supplies, both, they do both MRO and building products, and the formulation of Amazon Business. I think deals like when Whitecap acquired Construction Supply Group, and with Motion acquiring Kaman, I think they're more willing to let these big deals go through, because I've not heard about the FTC disputing any of these deals or really getting in the way of them. And the size of these deals 10 years ago, you would have thought that would have been an obstacle. So I'd love to hear what people in the audience think. It's an outstanding question. But I didn't hear a thing about about these deals in terms of the FTC, the HSR review being a problem. And, we listened to a lot of the earnings calls for these companies, and you're right. The analysts in the calls almost never even bring it up anymore.
I wonder if it's because Motion is part of the larger GPC. Wonder if that provides some kind of cover in this.
I don't know. I think it's more based on how much market share that these companies take up and whether it's going to have an anti-competitive effect in the marketplace and result in, prices being raised to customers, which is sort of what they're trying to prevent. So I didn't hear a thing. If anyone in the audience heard anything about this the HSR review being problematic for any of these deals, please, weigh in. But it just hasn't been an issue in any deal in distribution recently that I can recall. So I think the Kaman Motion does a lot more straightforward, it's a lot easier to combine synergies, right? Or
Yeah, there's a question to Randy Bro, the CEO of Motion, about the synergies. So question was, is it supply chain, share supply chain, distribution infrastructure? Is it cross-sell? Is it leveraging pricing in the inbound or outbound, given their scale? And Bro's comment was he expects to take advantage of all three of these.
Okay.
So, if you look, a little bit deeper, Kaman had kind of a jump start in the automation through acquisitions. Motion did the same.
Yeah.
As they fold the business under one brand, it will essentially double the automation business for Motion. So that's a really, really significant piece. KDG is bringing a lot of talent in that space to the acquisition. So they expect that by optimizing the branch networks, consolidating standalone branches, product distribution network, accelerating growth with sales, harmonize the supplier and the whole supply chain thing, they can be looking at a $50 million annualized synergy run rate. So that's a really, really significant increase in profitability for the business. They were a little bit less. They're really focusing less on the sales side of things. I think they were being a little bit more conservative in projecting that to the street than might actually be there. I think when you combine products like these, you have customers that are buying both of their kinds of products. This appears to me to be a better complementary position from a product standpoint than what we understand anyhow of the Lawson deal.
Yeah. And it's interesting, it's just occurred to me, but if you look at all three of these deals, these are extremely value-added distributors.
Oh yeah.
I mean, there's very little of the revenue here that is like spot buy kind of stuff, right? General MRO, you hop on a website, you make a small purchase and clear 10 POs off your desk. I mean, they all have some of that, but if you look at like the service centers that Motion operates, where they do repairs and rebuild pumps and that kind of stuff, and gear drives or whatever it is. I mean, it's really impressive. They've got quite a network of repair centers, and all three of these companies have in all three of these deals, there are sales reps that are highly trained and really consultative sellers, and they're different, right? I mean, Gexpro supporting production lines. Well, Whitecap has a version of that where they support construction projects, right? And there's a lot of complexity, which we talk about as being how distributors differentiate from these marketplaces.
Yeah, and I think that would be in contrast. There's a couple of deals going on in Jansen right now. There's a couple of acquirers where they're just acquiring everything in sight between $30 and $100 million, but that's a sector where there's far less value add, right?
Well, I think investors are realizing that, these highly value-added distributors are just much less exposed to disruption. I mean, I can't wait to see how the Lawson deal works out. I think we don't understand it very well, but I think the people doing it really do.
Yeah.
And I think it's I can't, I mean, the funny thing is, instead of the frustration with these deals is we know many of the people involved, some of the CEOs, et cetera, and we can't talk to any of them. I mean, because wouldn't be appropriate, right? They're not going to tell us anything anyway, especially if there's for the publicly held companies. But but I can't wait until the point where they've revealed enough of their strategy that we can, try to get some of them back on the show and have them talk about, how it's going and where they're going.
Right. Yes.
Okay, so let's pivot now and talk about we'll wrap up with Whitecap and Ram Tool. So, Whitecap's got like 400 branches. Ram Tool had, I think, 45 or something. So it's probably, close to a 10x bigger company, Whitecap. But these two were absolutely mortal enemies for a long time. So they would, hire each other's employees, and they had all these lawsuits going back and forth. So I was kind of surprised to see this deal happen, actually, because even though I think it makes a lot of sense strategically and financially, I thought potentially that there'd be too much bad blood between them for it to happen. So I'm glad they got over that. I think this is another one where the question about HSR review could apply, because, Whitecap is becoming, far and away the largest supplier of concrete construction products, industrial construction, or whatever you want to call it. And so, they just sort of dwarf everybody else in the space now. But it seemed like this one's going through unopposed as well. And I attribute that again to the incredible growth of Home Depot in this space, which it has done primarily on the construction side, done organically, not through acquisition. And so I think, this is a straightforward deal. They're going to pick up a bunch of business that they didn't have previously. They can probably rationalize some branch locations, because I know they overlap in some markets. And they, pick up a bunch of experienced salespeople. I mean, one of the hardest things to get in this construction space is experienced sales reps. I mean, they have to pay them a lot of money. They have years and years of experience, and however many reps Ram Tool has, that's a big talent pool to add to the Whitecap platform and give them a lot more resources to work with. And the other reality is bigger companies get better multiples. So in all three cases, you're taking smaller companies and joining them up to make bigger companies, which means they're inherently more valuable as long as you successfully execute the integrations.
So from what we understood with the construction supply group and Whitecap deal, that put them close to a $4 billion run rate, maybe high threes.
Yeah, I think they're over 5 now.
They're over 5 now, right?
Yeah.
So in the construction space, in the building materials space broadly, they're starting to get up there in the number 2, 3, or 4 space, right?
Yeah, but everyone who's above them, they don't compete with.
Right, like ABC, for example.
Yeah, they sell different products. They sell insulation or doors and windows or roofing or flooring, and Whitecap doesn't sell any of that stuff.
Yeah.
Just as a data point, I joined Whitecap as VP of marketing in 2013. I was there for 7 years. And when I joined, the company was $857 million in 2013. Now it's 9 years later and it's 5 billion. That's unbelievable.
Yeah.
And, so they've got so John Stegeman's the CEO. He was the president and then the CEO. He's always been the top person in the organization since he joined, also in 2013, or maybe 2012, somewhere around there. And then Alan Sollenberger is now the president, right? And that's really a dynamic duo. Those are very, very talented leaders. And, they're private equity owned again. I'm assuming there's an IPO in their future, although I don't know for sure. But man, I tell you, that is a case study that somebody should write about how John really just galvanized that company, culture, strategy, talent, and built this giant distribution company.
So when you look at this deal, so supplier synergies, product synergies, branch, where do you see the main action being?
I think the purchasing synergies are obvious because you're just bigger now.
Yep.
Although I don't know how much is left now that Whitecap is very, very large. I think this was probably a very straightforward deal in terms of valuation, because you could just look at the projects that Ram Tool had won in the marketplace, what those revenues were worth, estimate what you get for all the spot buy stuff that happens to support construction sites. You'd add some branch locations. So I think it's probably on the revenue side, on the sales and marketing side, but I think there's significant, redundancies that they can eliminate to take some costs out of the operation and add some supply chain / procurement synergies. That's my best guess.
I wonder if a next step for Whitecap is to expand their product categories. Right? You're saying they don't compete with ABC, they don't compete with Beacon, all those players. Great, we know that. Is there a next logical step? Have they gotten? Do they just not have enough more? Is there just not enough runway in their current sector to grow more in that sector?
It's still highly fragmented. They might. I don't have an opinion on that. I guess it doesn't strike me as obvious that they would do that. I think at some point in time they'll have to, I guess. But I think right now they're going to consolidate their operations. They're going to get more efficient. They're going to bring a lot more professionalism on the category management side. They're very sophisticated that way. They've got great category directors and fantastic, one of the best marketing departments. And I'm not saying that because of what they did when I was there. They've gotten a lot better since I left. And they have a great, sales and marketing machine and category management machine. They're going to bring all that expertise to all these acquisitions, build a bunch of efficiencies and leverage and go public, and all the people who own equity are going to make a fortune. That's what's coming next for them. So let's do a wrap-up question before we go. Do you expect this pace of M&A to continue through 2022? I mean, we'll ask this question on when we have Brent Grover on the show in a couple of weeks, or in a few weeks. But what do you think?
I think the pace at the smaller end of the market is going to increase significantly because there's a certain resource required to scale into this decade. A lot of it has to do with digital infrastructure, customer-facing digital infrastructure, overall digital transformation. Smaller companies just don't have the resources to do that. Right. And then COVID came along and accelerated the need for all of that by, pick a number, 3, 4, 5 years. So if I'm a mid-market distributor, 100 million to 500 million, I think there have to be a lot of 20 and 30 and $40 million companies that I could acquire. And what I would be looking at, and we'll look at this in the next session with Brant, is I'd be looking for companies that have good expertise, good customer base, don't have the resources to scale, right? So I think we'll be looking at this both from the being acquired side and from the acquirer side with Brant. But I think there's no shortage of that. And I think that's going to continue for the next couple or 3 years. There's a lot of 20 and $30 million companies where the ownership doesn't have succession plans, right?
Yeah, I think the other thing, and you referred to COVID, I think COVID really highlighted the differences between companies with good digital capabilities and those without. And so if you didn't have great digital capabilities, you really got hammered during COVID. And so sort of the haves and have-nots gap grew on digital capabilities. And so, if a good way to get that fast is to acquire somebody who's good at it, right?
That's one possibility. Another possibility is that if you were the acquirer, you have a platform that you can fold them into, right?
Sure.
So if you just look round numbers at the digital transformation that's required, it's easily a 7-digit number, too common number. It could be a couple of or $3 million. So if you're a $20 or $30 million distributor,
you can't do it.
You just can't do it, right? So I think the move is if you're the company that's going to get acquired, how do you position in a way that you get the best valuation when the music stops, right? If we're playing musical chairs, and then if you are the acquirer, how do you spot the companies that are really going to be part of a platform where you can bring value to that company that is accretive within 18 months?
Good, interesting. Okay, so we'll continue this discussion on February 16th when Brent Grover joins us. Brent is a NAW fellow. There's only 4 of those, right? You really have to be a wizard in wholesale distribution to be named a fellow by the National Association of Wholesaler Distributors. And so Brent will be joining us to talk about what's going on with distribution M&A and how he sees the sort of success factors in making acquisitions and integrating them, as well as, trends for the rest of 2022. We do have a show on February 1st, but I wanted to promote this one because it continues this topic about what's going on with distribution M&A. We hope you will join us for our 2022 State of E-commerce. That's on February 2nd at noon. So that's brought to you by Oracle, NetSuite, and Optimizely. The show with Brent Grover is brought to you by Oracle, NetSuite, and Cavallo. You can reach us at distributionstrategy.com. Feel free to visit us there, click on events, and reach out to us if you have questions, comments, protests, complaints, etc. Our contact information is iheller@distributionstrategy.com and jbein, B-E-I-N, @distributionstrategy.com. Thanks for joining us today. We'll see you on the next episode of the Wholesale Change Show. In the meantime, be well, and I hope you sell a lot of stuff. Jonathan, great to work with you again, my friend. We'll talk to you soon.
Take care.